Welcome to the Knapp Business Solutions YouTube channel, where we tackle the IRS and help you come out on top. If you've got a tax mess or a question, please reach out. You can call us at 806-576-3296, and I'd love to answer your question. I'm Josh. I'm the CEO of Knapp Business Solutions, and I'm an EA with over 20 years of experience in tax. Today we've got a question about gambling. We're going to play this video where we'll have a question, and then I'll hop back on and answer that.
I'm in a bit of a bind, and honestly, I'm not sure what to do next.
My accountant just dropped me as a client, and it's all because of my gambling winnings.
I have over 300 W-2G forms, each representing a win, and they're spread across 11 different states. It's a complex situation, and I'm completely overwhelmed trying to figure out how to file all of this. So, I'm reaching out to you all. What should I do now to get my taxes filed?
This is a very interesting situation, and it is a good question. So, we've got to talk through a couple of issues that are complex on this topic. First off, 300 W-2Gs is a lot. That means you're gambling a lot. And in 11 different states is also a lot. These are big numbers. And this is actually a real question that we got. What I will tell you is you've got to find somebody that is well-versed in multiple states. And I'm sorry that your guy let you go. That is unfortunate. But you want to find a tax pro that's well-versed in those states and able to tie all these back to your return. All of these W-2Gs are going to be reported on your tax transcript with the IRS. The IRS is going to be aware of all of them. You've got to report all of them back to the federal ID number on that return. It's a lot of data entry into tax software to report them properly. Next, you've got to track your expenses. When you're doing this much gambling, it's very important that you're keeping up with your expenses related to the gambling. What money you spent to get those gains. So we've got to have that number as well. Hopefully you've got detailed records on that. If you're not doing it now and you're still doing this kind of gambling, I would tell you, start a spreadsheet where you're at least tracking your funds. At the casino at the end of the night, you can go to the counter and ask them to provide you with a list of your expenses and what you spent in the casino that day. And they'll track that for you. So that's going to be very helpful in determining what your losses are and netting those against the gains. Of course, those losses will be reported on Schedule A, and that's where we would look to offset those gains, assuming you've got another job, and that's how we would do that. Now then, with regard to 11 different states, you want somebody well-versed in those states because when you've got 11 different states, there's a lot of rules that dictate how those states interact with each other. If you pay tax in one state, you should get credit for that tax in another state. And you've got to ensure that that's all handled properly, and definitely adds another layer of complexity to your return. I would strongly recommend when you're looking for somebody with the heart of a teacher that's going to sit down with you and explain all of these different nuances and the details behind them and how you want to track and account for those expenses, those winnings, to ensure that everything is reported back to each state and those taxes that are due are paid properly. If you're doing that much gambling, I am a little bit worried about your mental health. I would recommend you get with somebody that can talk you through what may be causing you to do this much gambling. It's definitely worth your while to investigate. If you've got a tax question and it is complicated, or it's not complicated, it's simple, but you just can't find the answer, feel free to reach out. You can go to our website, tax.pro, and you can go to the contact page and fill out the form, and I'll be happy, if I can, I'm going to answer the question here. If not, you can reach out to my team, and we're more than happy to assist you with whatever complexities you have in your tax situations. Hey, and if you're enjoying this content, don't forget to like and subscribe to our channel. I'm so glad that you've joined us. Thank you so much. Welcome back. I'm Josh, the CEO of Knapp Business Solutions, and we're going to get to a question. I will be happy to answer it.
My friend and I started a partnership. He contributed crypto, and I contributed know-how. We didn't file our 2024 return, and we are trying to get it done by October 15th. We sold the crypto and purchased a different crypto. Do we have to report the gain on that transaction?
There's a lot of things in this one. So first off, we have a partnership return. Partnerships are due on March 15th. If you extend them, the new due date on a partnership return is September 15th. When we received this question, this was closer to October 10th, which would make it late. Late file partnership returns, IRS will assess approximately, this is indexed for inflation, so it changes, but about $200 per partner per month that those are not filed. So if you have two partners, it's $400 per month. And if you take that for the whole year, you're right at $5,000 in penalty for late filing. And they will assess that back to the start of the year. If it's just 10 months, then you're at $4,000. Thing number two is, with regard to this cryptocurrency, when you contribute the cryptocurrency to the partnership, or whenever the partner contributed the cryptocurrency to the partnership, that the basis to the partnership is that partner's basis in that cryptocurrency. What that means is if the partner paid $100 for the cryptocurrency and he puts that into the partnership, then the partnership's basis is $100 in that cryptocurrency. Let's say the cryptocurrency is now worth $1,000. Well, this deals with Section 1031. And Section 1031 is what allows us to do like-kind exchanges. Keep in mind, the only thing that we can do like-kind exchanges in the current tax law is real property. We've, in the past, been able to do all sorts of different types of exchanges with property, but currently we can only do real property. And cryptocurrency is not real property. As a matter of fact, it's specifically excluded on 1031, meaning that if you sell that cryptocurrency and buy another cryptocurrency, you have gain on the sale of that cryptocurrency. Originally, the basis was $100. You sell it for $1,100. We have a gain of $1,000. You're going to have, whenever you sell that crypto, the partnership would have had the $100 basis, so you're going to have a taxable gain in that example of $500 each, and that will be taxed on your tax returns. Then if you take the funds and you buy more crypto with the funds, or maybe it went from crypto to crypto, you will have a new basis in the new crypto of $1,100. And then as it increases in value, you will capture that if you exchange it for something else. So, lots of moving pieces here. Number one, it's important for you to remember the due date of the partnership return, March 15th, with an extension September 15th. That's a 6-month extension. Number two, you put an asset into a partnership, for the most part, the basis of the person that contributes that asset, that is their basis, not all the partners' basis, just that one partner's basis. I hope that you found this answer helpful, and if you've got more questions, feel free to reach out to our team. If you're enjoying this content, don't forget to like and subscribe to our channel. So glad that you've joined us. Thank you so much.
Unlock the power of full-service payroll with Payority. What is full-service payroll? It's the ultimate hassle-free solution for managing your business's payroll needs. With full-service payroll, every aspect of payroll processing is handled for you, from calculating wages and taxes to filing compliance reports and ensuring timely payments. You get peace of mind while saving time and resources. Why Payority's full-service payroll stands out. Complete payroll management. We handle everything: wage calculations, tax withholdings, direct deposits, and more. Compliance made easy. Stay worry-free with expert handling of federal, state, and local tax regulations. Employee self-service. Empower your team with easy access to pay stubs and tax forms through our secure portal. Dedicated support. Our payroll experts are with you every step of the way, ensuring accuracy and reliability. Ready to simplify your payroll? Visit Payority.com to learn how our full-service payroll solutions can transform your business.
Welcome back. Thanks for joining us. We are going to go to a question. I'm going to play this. This comes from John in Texas.
The October 15th deadline looms, and this decision impacts the future of my business significantly. Each year presents a delicate balancing act between business growth and financial responsibility. I could make a substantial contribution to my SEP IRA, thereby reducing my taxable income. This move saves on taxes, but it also ties up capital needed for operations. Alternatively, I could simply pay the full tax amount, which keeps cash flow flexible. With the deadline approaching, should I contribute to my SEP IRA or accept the high tax bill?
John, thanks for the question. This is a good one, and it is a challenge for most business owners. You're going along in business, things are going well. Obviously, you've had a profitable year. Great job. Once we've got that profitable year, we've got to make a decision. Do we want to put some money into the SEP to reduce our tax bill? We can still do that through the October 15th deadline. Or do we want to pay the tax? With this question, I want to talk through a couple of things. Number one, this tells me a little bit about your situation. And it appears to me that you're not being very proactive in your tax planning throughout the year. You're being more reactive. And what I would challenge you to do is to be a little bit more proactive. What I mean by that is instead of contributing after the deadline of that return, so this would be a 2024 SEP contribution. January 2024 was a long time ago from October of 2025, approximately 22 months ago. For retirement, it's better, if you want to think early is better than late. So what I would say is be more proactive, and let's see if we can work on your systems to where you're doing that contribution, maybe not into a SEP, I'll talk about that in just a minute, but you're doing that contribution into your retirement account or into your retirement plan earlier, like 22 months earlier than you are 22 months later, because that's 22 months of growth that you've missed out on by not contributing. Now, should you contribute to the SEP to save tax dollars? I love it, and I love this topic. And the answer gets a little bit tricky. Some of it depends on your own cash flow, and some of it depends on your own financial health. So if I'm you, I don't have any personal debt, I don't have anything else saved for retirement, and I've got the cash in the bank, and it's not going to drain all of my money, definitely going to do the SEP, and I'm going to put the money in there. And that's going to reduce my taxes. I also still have to have the money to pay whatever the remainder of that tax bill is. And so as long as you can cover all of that cash flow wise, definitely go ahead and do the SEP. The SEP is better than nothing. But remember, anytime you can put money into a 401k, so in your case, instead of a SEP, I might challenge you to look at like a solo 401k. Anytime we can put money into a 401k where we have a match, that's best. Of course, with the SEP, we've got the employer match, whatever percentage. With the SEP, you'll have your contribution amount, but with the 401k, you've got the match. The reason that I would make this change is because Roth, you can do Roth in the solo 401k, you can't do a Roth SEP, okay? Roth grows tax-free. So anytime we can do 401k with company match, especially if that company's not ours, we're gonna do that first. Then we're gonna do Roth, and then after that, we would look at like SEP options or deductible options, tax deferred options, okay? In the future, what I would tell you to do, instead of doing the SEP, go ahead and work on doing the Roth, because it's going to grow tax-free. And you could start the Roth contribution for 2025. We're still behind, but you could start that today, and that's what I would advise you to do. Thanks so much for the question. So we'll see you on the next one. Welcome back. We're going to go to our next question. We're going to roll the clip.
I got my IRS tax refund back, and I'm very excited about it. It's a good amount, almost enough to fully pay my credit card debt, a relief. But sadly, I currently have absolutely no savings whatsoever. I'm torn between getting rid of that credit card balance or starting an emergency fund right now. What do you think I should do?
I appreciate this question. I'm glad you sent it in. So let's talk through some options with what to do with your refund. I'm a big follower of Dave Ramsey. I would definitely recommend you go watch The Ramsey Show. He has a program that is proven effective for eliminating debt and building wealth in personal finance. He has these 7 steps that are called the baby steps. And I would recommend that you follow the baby steps with your tax refund. And then I would recommend you get on a budget so that you don't go back into debt and you have a much more prosperous future. So what does that look like? The 7 baby steps are this. Step 1 is a $1,000 starter emergency fund. Step 2, you list your debts smallest to largest and you pay them off from the smallest balance through the largest. Step 3 is building a 3 to 6 month emergency fund. Step 4, 5, and 6, you work simultaneously. So step 4 is saving for retirement. It's 15% for retirement. Step 5 is kids' college, if it applies. Step 6 is paying off your mortgage early. And then baby step 7 is live and give like no one else. Now, not all tax pros agree with personal finance, but this is a great way. I have done these steps, and it's a great way for you to build your personal finance. So I would say, first with that refund, if you don't have a $1,000 emergency fund, baby little emergency fund, start with that. That's not enough, but it's a good place to start. So take $1,000 of your refund and put it there. We're going to put this in a savings account that we're not going to touch. Then go to baby step number 2. List those debts smallest to largest and pay them off by balance and pay them off with the smallest first. Once you've done that, then I would work on that 3 to 6 months of savings for that emergency fund. So it sounds like for you, you won't have enough to get all the way through your debt snowball, debt smallest to largest, baby step 2. So I would do baby step 1 and get as far down that list in baby step 2 as you can, and then get on a budget and squeeze everything out of that budget that you can to get rid of the debt. Thanks again for this question. If you have a question, you can call us at 806-576-3296. You can leave a voicemail with your question, and I would love to give you an answer. Don't forget to like this video and subscribe. Thank you so much for tuning in. I can't wait to talk to you soon.